Investing is hard. Even most professional investors don't beat the market in the long run. And let's be clear, your average Joe is likely to lose money in the market. But that doesn't need to be you. Today, I'll share with you a strategy that I use and how it's performed in the last 50 years, so you can decide if it is for you. This strategy is called dollar cost average. But first, let me introduce myself. I'm a software engineer and I have a master's degree in the finance area. I'm currently working in investment banking as a quant developer for an interest rates desk. Now, having this background, you would expect that I analyze single stocks and implement crazy derivative strategies. But the truth is, I don't. I follow the most boring strategy out there. When I get paid, I set aside a fixed percentage and I dump it in the market. You could do this by buying an ETF or a mutual fund, depending on what's better with the tax code in your country. But why is this a good option? Well, you're likely getting a salary every 2 weeks or every month or whatever, and this money is getting ripped off by inflation every single day, unless you do something about it. However, when you're just starting in your investment journey, you might think, well, I'll just wait till the market crash and I'll buy the dip. Trust me, we've all been there. The problem with that approach is markets behave unexpectedly. You cannot time the market. Predicting when a recession is going to come is almost impossible. We all know they're going to come, we just don't know when and have no way to precisely tell. If you wait out, there is a high probability that the market's raised by a value so high that when it crashes, it's still above the level that you could have bought for. Also, when a crash happens, you have no way to tell whether it will keep crashing or come back up. For all these reasons, you should take your emotions aside and invest every single time you get paid. Make a budget and stick to it. When doing this, 3 or 4 times a decade, the markets will crash. Well, no big deal. You have to keep going with your strategy and don't care at all. You shouldn't care if it falls 20, 30 or 50%. It is going to happen. The beauty of this strategy is cost bases will get average over time, so you don't really have to spend time thinking what or when to buy. Well, sounds simple enough, but how has this strategy performed over time? Let's take a look. I got the data from the S&P 500 daily prices since 1980 and performed a little analysis. Starting from 1980, the strategy has had 10-year average of 12.5% return and 20-year average of 10.8%. That means that in every 10 or 20-year window, that's what happened on average. I also got some more statistics, like the maximum, minimum and median return. What might concern you the most, the minimum return, has never been negative on a 20-year frame. It's been 3.3%, slightly beating inflation. However, there has indeed been periods where in 10 years you might have lost some money, where the minimum return has been minus 4.5%. Again, this is a long-term investment strategy, so this is only helpful if you're thinking in decades, not weeks, months or years. The idea behind dollar cost average, or DCA, is to get a return on the money that you get elsewhere, not to make a living off it at the beginning. You also don't have to time the market or predict market crashes. It is a helpful way to build wealth, slowly but surely. It's not a get-rich-quick scheme, and in my opinion, investing shouldn't be viewed as such. You should never touch this money and only contribute what you can afford to lose, not what you might need in the near future. I hope this gave you a clear picture of what DCA is, but for now, I'll see you in the next video.